I want you to imagine something with me for a moment. Picture a simple piece of wood, a 2x4, the kind you have seen 1,000 times at construction sites, in hardware stores, stacked in the beds of pickup trucks. Now imagine that this ordinary piece of lumber has become one of the most consequential economic battlegrounds on the planet. I know that sounds dramatic, but I am going to show you exactly why it is not an exaggeration. What if I told you that decisions being made right now about this wood are determining whether millions of families will ever be able to afford a home? What if the price of that 2x4 is reshaping mortgage approvals, construction timelines, and even where people choose to live? This is not a story about trade policy buried in government reports. This is a story that will touch your wallet, your neighborhood, and possibly your future. And it all comes down to a trade war that very few people saw coming, and even fewer understood until it was too late. I have been following international trade disputes for years, and I can tell you that most of them play out in predictable ways. One country imposes tariffs, the other retaliates, there are negotiations, and eventually some kind of compromise emerges. But what is happening right now between the United States and Canada over softwood lumber is different. This dispute has taken a turn that nobody anticipated, and the consequences are rippling through both economies in ways that will take years to fully understand. The United States imposed tariffs on Canadian lumber that range from 35% to nearly 48%, depending on the producer. These are not small adjustments designed to send a diplomatic message. These are crushing duties meant to fundamentally alter the economics of cross-border trade. And Canada, instead of backing down or waiting for negotiations, has responded with a strategy that is rewriting the rules of the entire North American lumber market. When I first started digging into this story, I expected to find the usual back and forth between governments, the kind of posturing that eventually leads to a deal. What I found instead was something far more significant. Canada has launched a $5 billion strategic response that is not about waiting for tariffs to be lifted. It is about building an entirely new economic structure that reduces dependence on the American market permanently. This is not a temporary measure or a negotiating tactic. This is a fundamental restructuring of how an entire industry operates. The Canadian government has implemented mandatory procurement policies requiring federal agencies to buy Canadian lumber for government projects. They have created loan programs for mills struggling with the tariff impact. They have funded regional support initiatives across every major lumber-producing province. And most importantly, they have started redirecting exports to Europe and Asia, building new trade relationships that will not disappear even if the tariffs are eventually removed. I want you to understand what this means for the housing market in the United States, because this is where the story gets personal for millions of Americans. The United States consumes roughly 70 billion board feet of lumber every year. Domestic production covers about 58 billion board feet. That leaves a gap of approximately 12 billion board feet that has historically been filled almost entirely by Canadian imports. When you impose tariffs that make Canadian lumber 45% more expensive overnight, you do not just create a trade dispute. You create a supply crisis. And when you have a supply crisis in one of the most essential building materials, you get exactly what we are seeing right now: construction costs climbing, housing starts declining, and a shortage of homes that was already severe getting dramatically worse. The numbers I am going to share with you in the coming segments are not projections or estimates. They are the reality that builders, buyers, and families are facing right now, and the path forward is far from clear. I want to take you inside the Canadian response to these tariffs, because understanding what Ottawa has done is essential to grasping why this situation is so different from previous trade disputes. When the United States imposed duties reaching as high as 47% on certain Canadian lumber producers, the expectation in many quarters was that Canada would protest diplomatically, perhaps impose some retaliatory measures, and ultimately come back to the negotiating table looking for relief. That is not what happened. Instead, the Canadian government unveiled what I can only describe as a comprehensive industrial strategy designed not to win concessions from Washington, but to fundamentally reduce the importance of the American market to Canadian lumber producers. This is a pivot, not a pause, and the implications are enormous. At the center of this strategy is something called the Buy Canada procurement policy. This is not a vague preference or a suggestion to government agencies. It is a binding requirement that federal agencies and crown corporations must prioritize Canadian suppliers for government projects, with lumber explicitly included in that mandate. Think about what this means in practical terms. Every federal infrastructure project, every public housing development, every military installation, every government building that requires construction must now source Canadian wood, even if foreign alternatives are available at lower prices. The scale of this guaranteed demand is massive. We are talking about billions of dollars in annual construction spending that is now locked into domestic supply chains by government mandate. For Canadian mills facing the sudden loss of their largest export market, this created an immediate floor under demand, a protected home market operating at stable prices while international trade remained turbulent. But the Canadian government did not stop with procurement mandates. They understood that many mills, particularly smaller operations, would face immediate cash flow crises as their American customers disappeared overnight. So they mobilized the Business Development Bank of Canada to offer loans ranging from $2 million to $5 million to small and medium-sized lumber firms, with favorable interest rates and extended repayment periods. Larger enterprises gained access to expanded tariff loan facilities with improved terms. The goal was clear: prevent a wave of bankruptcies that would permanently destroy productive capacity. Regional governments moved in parallel with federal authorities. Funding for tariff response initiatives jumped from $450 million to $1 billion over 3 years. Ontario allocated $20 million specifically for forest access roads and another $10 million to support sawmill chip programs. British Columbia launched a $2.5 million manufacturing jobs fund aimed at modernizing operations and preserving employment. The Prairie provinces rolled out their own response packages. Every major lumber-producing region received coordinated federal and provincial support simultaneously. I have covered government responses to trade disputes before, and I can tell you that what Canada has done here is qualitatively different. This is not crisis management. This is industrial policy designed to reshape an entire sector of the economy. The loans being provided to mills must eventually be repaid, which means those costs get built into future pricing structures. The modernization investments require returns, which means companies will seek markets that support higher margins. And because the Buy Canada mandate guarantees domestic demand for Canadian lumber, government projects become a captive market capable of sustaining elevated price levels indefinitely. Once restructuring expenses are embedded in production costs, prices rarely return to previous baselines. Canadian producers now have a protected domestic market, government financing to modernize their operations, and coordinated support at every level of government. They are not waiting for American tariffs to be lifted. They are building an industry that does not need the American market the way it once did. I need to be honest with you about the immediate costs of this transformation because the Canadian lumber industry has absorbed real pain over the past months. 22 mills have closed permanently. Roughly 5,600 workers have lost their jobs. Around 50 additional operations have faced temporary curtailments. These are not abstract statistics. These are communities that have depended on forestry for generations suddenly facing unemployment lines and uncertain futures. I do not want to minimize the human cost because it represents genuine hardship for thousands of families. But I also need to explain why these closures, as devastating as they are for the people involved, are part of a strategic consolidation that is making the surviving industry stronger rather than weaker. The closures were not random. Companies like West Fraser, Camphor, and Interfor used this crisis as an opportunity to shut down their highest-cost facilities and concentrate production in more efficient modern plants. This is painful restructuring, but it is purposeful restructuring. The mills that remain are the ones with the best equipment, the most productive workforces, and the lowest per-unit production costs. Government loans helped bridge the gap during this consolidation, providing the financial cushion that allowed companies to make strategic decisions rather than simply scrambling for survival. The result is a Canadian lumber industry that is leaner but more competitive, operating at higher efficiency levels with guaranteed domestic demand supporting the transition. When you combine mandatory procurement policies with targeted financial support and strategic facility closures, you get an industry that is repositioning for a fundamentally different market environment. The currency situation has added an interesting dimension to this story. The Canadian dollar has weakened significantly against the American dollar, trading around $1.45 to the US dollar. Under normal circumstances, this would make Canadian exports dramatically more competitive. A weaker currency means foreign buyers can purchase more product for the same amount of money, but a 45% tariff overwhelms any exchange rate advantage. Even with a favorable currency, selling into the United States under current conditions remains economically unattractive compared with domestic contracts or alternative export markets that do not impose punitive duties. This is why we are seeing Canadian producers redirect their attention toward entirely different trading partners. British Columbia, which has historically been a major supplier to construction markets in Washington, Oregon, and California, has begun shifting roughly 10% of its exports toward new destinations. The initial focus has been on the United Kingdom, which imports approximately 2.5 billion board feet of lumber annually and has traditionally sourced from Sweden, Latvia, Ireland, and Finland. European timber supplies are facing their own constraints right now. The loss of Russian wood following export bans has created gaps in supply chains that buyers are eager to fill with reliable alternative sources. Canadian producers are positioning themselves as supplemental partners in markets that are actively seeking diversification. Asian markets are also coming into focus. Japan and South Korea have distinct grading and dimension requirements that differ from North American standards, but Canadian mills are investing in equipment upgrades to meet those specifications. British Columbia already has significant shipping infrastructure, including port facilities originally built around liquefied natural gas exports, that provides logistical pathways into Pacific markets. Even if margins in these alternative markets are lower than pre-tariff American sales, the absence of a 35 to 47% duty can produce comparable or even better net returns. And once buyer relationships are established and supply chains recalibrated, reversing those trade patterns becomes extremely unlikely. Now I need to turn your attention to the United States because the supply situation facing American builders has become genuinely critical. Let me walk you through the numbers because they tell a story that no amount of political rhetoric can obscure. American annual lumber consumption runs approximately 70 billion board feet across residential, commercial, and industrial applications. Domestic production capacity sits around 58 billion board feet. Simple arithmetic reveals a gap of roughly 12 billion board feet that must be filled from somewhere. Historically, that gap has been covered almost entirely by Canadian imports flowing freely across the border through supply chains that operated with minimal friction and almost automatic coordination. Those supply chains are now disrupted, and the volume that used to flow south is increasingly being redirected to Europe, Asia, and Canadian domestic consumption. I have heard representatives of the American lumber industry argue that domestic mills can fully meet national demand if given the opportunity. I have examined the capacity figures carefully, and I can tell you that this claim does not align with the actual numbers. Even accounting for recent investments in expanded production, the mathematics simply do not support full domestic substitution. There is a shortfall, and that shortfall is not closing quickly. The housing sector is feeling this impact most acutely. The United States is currently short approximately 4.5 million homes according to recent estimates, a deficit that has climbed from 4.3 million in a relatively brief period. The National Association of Home Builders has echoed concerns about structural shortages that are worsening rather than improving. Annual housing starts last year reached about 1.36 million units, with forecasts now pointing toward 1.2 to 1.3 million for the coming year. If you do the math on closing a 4.5 million unit deficit while keeping pace with population growth, you would need to build roughly 2 million homes annually for an entire decade. Instead, construction activity is trending in the opposite direction. Lumber represents a significant portion of overall building costs, typically accounting for 15 to 25% of the expense of constructing and finishing a typical American home. When framing lumber composite prices climb to $872 per thousand board feet, and analysts project sustained levels in the mid-500s to low 600s through the coming year rather than returning to the $450 to $500 range that builders had grown accustomed to. Those increases feed directly into final home prices. I have seen estimates suggesting that the current tariff situation could add around $6,000 to the cost of a typical new home. But that estimate was based on assumptions of temporary disruption and resumed Canadian supply. With supply now being permanently redirected and tariffs showing no signs of removal, that figure appears conservative. The actual cost impact is likely higher and will persist longer than initial projections suggested. Mortgage rates have dipped towards 6% recently, which provides some relief on the financing side. Lower rates mean buyers can afford slightly higher purchase prices without increasing their monthly payments beyond qualification thresholds. But lower rates cannot compensate for construction costs that push entry-level homes beyond what many families can afford. A property that might have been priced at $200,000 becomes $220,000 or $240,000 as material costs rise. Families who were already stretching their budgets to qualify for financing find themselves priced out of the market entirely. Demand softens not because households lack interest in buying homes, but because affordability limits are reached. Housing starts decline even as the shortage persists. This is the paradox the American housing market now faces. Overwhelming demand for affordable housing combined with supply constraints that push prices beyond what the market can absorb. I want to step back now and consider where all of this leads, because the long-term implications extend far beyond quarterly earnings reports or monthly construction statistics. What we are witnessing is a fundamental restructuring of the North American lumber market that will shape housing affordability, trade relationships, and economic dynamics for years or potentially decades to come. The decisions being made now are not easily reversible, and the patterns being established will likely persist long after the current political moment passes. Canada is emerging from this crisis with an industry that is consolidated around efficient facilities, supported by binding domestic procurement mandates, and increasingly connected to global buyers in Europe and Asia who will not simply disappear when trade tensions ease. American mills are enjoying higher margins on existing output because reduced Canadian competition has tightened supply and pushed prices upward. But higher per unit profits do not offset the broader contraction and housing construction that limits total volume. You cannot sell lumber for homes that are not being built. And homes are not being built because the materials to build them cost too much for buyers to afford. This is a structural problem, not a cyclical one. The social consequences are already visible in rental markets and demographic trends across the country. As home ownership drifts further out of reach for young families, rental demand intensifies and rents climb. Multi-generational households become more common as children remain in parental homes longer or return after periods of independence. Household formation slows as young adults delay marriage, childbearing, and other life transitions that typically accompany establishing independent residences. The housing shortage that currently stands at 4.5 million units risks climbing toward 5 million and beyond if construction remains constrained year after year. Treasury officials have floated the idea of declaring a national housing emergency, acknowledging that current trajectories are unsustainable. Building millions of additional homes at accessible price points requires stable, reasonably priced inputs. When one of the most critical materials remains structurally elevated, the challenge intensifies significantly. I have spoken with builders who describe a planning environment where input costs are no longer predictable even from month to month. Projects that made economic sense when they were designed become marginal or unprofitable by the time construction begins. Some builders are pulling back, focusing only on higher-end developments where margins can absorb material cost increases. Entry-level and workforce housing, the segments most needed to address the shortage, become increasingly rare because the numbers simply do not work. Meanwhile, Canada continues building trade relationships that are designed to endure. Buy Canada procurement rules do not carry automatic expiration dates. The infrastructure upgrades financed through the $5 billion strategy represent permanent improvements that will shape production capacity for decades. Export relationships with European and Asian partners, once established and stabilized, tend to persist because both buyers and sellers have invested in making them work. Lumber from British Columbia moving toward London or Tokyo has no compelling reason to revert to Seattle in the absence of dramatic changes in American trade policy. The goal of protecting American lumber producers from foreign competition has instead accelerated a Canadian restructuring that reduced dependence on the American market and redirected supply elsewhere. American builders now navigate higher input costs without a clear path to restoring the previous trade balance. The arithmetic remains unforgiving. Domestic output near 58 billion board feet cannot cover consumption around 70 billion, and the missing volume no longer flows freely from across the northern border. This is the new reality of the North American lumber market, and it will define housing economics for years to come.